In this video, we are going to take a look at 5 different ways loan officers are paid in the real estate and mortgage industry so it can help you figure out if you're getting compensated for what you're worth. Hi there, my name is Megan and I'm a loan officer and a mortgage broker owner with over 18 years of experience in the mortgage industry. And in this video, we're going to take a look at 5 different ways loan officers are paid if you enter the mortgage industry. And the 5 ways we're going to go over today are: number 1, commission-based pay structure; number 2, salary plus commission; number 3, the draw against commission; number 4, an hourly wage; and number 5, profit share or net branch. I believe that loan officers are some of the most important people in the real estate transaction. The work that loan officers do determine if a house actually gets to the closing table. So what do they make for this extremely important role? And it's one of the reasons I want to let you know that we help mortgage professionals and real estate agents open independent mortgage brokerages, because it helps you generate more income in less time by using the same mortgage business blueprint that grew our 7-figure mortgage company. And we do this through videos, our blog, courses, all on the collablife.com website is where you can check it out. So if you're new here or simply returning, please make sure you subscribe to the channel so you don't miss any of our videos that might have more valuable content for your business, especially when it comes to making money. As a loan officer, you have several options when it comes to how you get paid. So whether you're just starting out or you've been in the business, you're going to want to stick around because you might find out that there are other options and ways to get paid that you'll want to look into those opportunities and the companies that pay that way. Most people think that loan officers get paid a salary, right? But there really are actually many different ways to get paid as a loan officer. And that's why I wanted to focus on these 5 ways. So let's just jump right in and start talking about the money. So number 1, commission-based pay. This is the most common way that loan officers are paid, and it typically ranges from 1 to 2% of the loan amount. We'll get more into this. 100% commission is really the most common way that I see the industry going and has been, and it's a way for businesses to not pay out as much of the benefits and some of the other pieces until someone really starts building a book of business. And it really depends, as a loan officer, where you work and what system that they use if you can get paid commission, salary, hourly. And although you're being paid fully commission, I do want to make sure you understand that you are a W-2 employee where taxes are taken out. Now, commission-only pay structures vary wildly. So make sure you understand how the company you're joining or that you work for, how they calculate commissions before agreeing to whatever you're going to decide on. Also ask how often commissions are paid and what determines when commissions are paid. And it's really important to know this before you close a loan and before you get your first paycheck. I have found that this pay structure, being able to go fully commission-based, happens most frequently at mortgage brokers or retail lenders. Now, before moving on to the second way loan officers are paid, I want to make sure I walk you through and answer one of the more common questions that confuse a lot of new loan officers, and that's, well, okay, we're commission-based, but how are commissions calculated? And so commissions are typically calculated based on what's called basis points. And really, all basis points is a percentage. And so I'm going to give you an example, a very simple example. Let's use a $100,000 loan. If I close and help someone get $100,000 and I was getting 50 basis points, that's $500. If I was getting 100 basis points, that's $1,000. If I was getting 125 basis points, that's $1,250 on that same $100,000 loan we started with. Most loan officers who are 100% commission-based are getting somewhere between 75 basis points to 125 basis points on the loans that they close. There are structures that are lower. Let's say if you don't self-generate your own loans, you close, and there are structures that are definitely higher if you're paying for more of your own expenses. So understanding the support you'll get and where your business needs to come from is really important when you're making a decision on where to work based on their pay structures. Number 2, let's go into salary, because this is the second most common way I would say loan officers are paid, and it's a great way for people that are starting. Salaries probably range somewhere between the $30,000 to $60,000 a year range. Now, if you're looking for a job with a steady income, a salary is a great way to start, but also asking about, is there opportunities for commission and bonuses on top of your salary? And because I find many of your local banks that you can walk into, they typically pay salaries with very small bonuses or commissions. This is a really good thing for any of you that are starting out and may not be closing a lot of loans yet. But as soon as you begin closing more loans, getting more business, the commission structure is almost always going to be better, or doing salary combined with bonuses and commissions. Now, some banks and even mortgage companies will come up with that mix of salary plus commission. We do that at our brokerage. Salary plus commission or bonus, this option provides a steadier income, but it also offers the potential to make more money with you being able to generate your own business and having successful loans closing. And it combines the best of both worlds of commission and salary while you're building up a book of business. Maybe you come in and you help a bigger producing loan officer while you're just getting a little bit of your own business. So I like that option for new people, and I think it's a great way to get started. Let's now get into the third way, the draw against commission. This method of pay is a certain amount each month that you get paid whether you close a loan or not. Under this system, the loan officer is given a certain amount up front, but they have to earn it back through the loans they close, and the draw always has to be paid back. So one word of warning when it comes to taking a draw against commissions, make sure you have a good understanding of your company's policy for draws, what their closing ratio is at that particular company. Before agreeing to do that, you want to make sure you're going to work somewhere that can close more loans and don't have restrictions. So here's an example of a draw. So let's say that you are told that you'd get paid $1,000 2 times a month, $2,000 a month, $24,000 a year draw. Let's say in 1 month you close $400,000 in loans and you get paid 100 basis points. So that would be 400 times the 100 basis points equals $4,000. So when you get paid, you're first going to get that 1,000, then another 1,000 for your draw. The loans are closing. And then once the loans close, you don't get that whole $4,000. You first have to pay back that $2,000 draw, and then you'll get $2,000 in commission over. That is what a draw against commissions. So some good questions to ask about draws with a company that you're thinking of going to work for is, do you stop draws if you reach a certain amount that you have to pay back to the company? Do you have to take draws? Can you maybe not take draws? Would be some of the questions that I would ask. Number 4, the hourly wage. Some companies pay their employees an hourly wage regardless of how many sales they make. Very similar to your salary option, but once it goes hourly, you just want to make sure that you're understanding all the things that revolve around that hourly rate and how the position is structured. I think it's another great option for any of you starting out in the industry, or if you don't have a lot of experience. It removes the risk of having to pay back a draw, and it also provides that steadier income. But those important questions, again, that you'll want to ask if you were being paid hourly are, how much per hour am I being paid? How many hours per week am I getting paid for? Are there benefits that I receive through this position? At what point can I also be paid commissions or bonuses? Because you don't want to go start somewhere that never pays commissions or bonuses if your goal is to really grow up a book of business. So great option, just make sure you ask those questions. Now let's go to our final way that loan officers can be compensated, which is the profit sharing. So loan officers can be eligible, depending where they work, for that profit share. It could be a stock option, it could be how a branch does if you work at a bank, or it could be based on the performance of the branch that you manage. The most common profit sharing setup that I see is what's called net branches, or by owning a mortgage brokerage like I do. Now, in both scenarios, you're taking home the additional money that is available after commissions and expenses are paid at that office, And we are going to create a video about the differences between running a net branch and owning a mortgage brokerage at a later date. For right now, knowing it's really that net amount after expenses that you get to take home. And in summary, there are a few things to consider if you're looking at any of these options, because the right pay structure for you as a loan officer is really going to depend on what type of work you're good at, what you want to do, feel comfortable with. Commission-based is great for sales-oriented loan officers like I was, but there are some people that want that steadier income and they need more time to ease into certain positions. And also, you need to consider if you're planning on building a team or if you're great at growing a book of business. If those are things that could take you a lot longer, you'll really want to think about where you're going to start before jumping into that. So I hope you can see that there are a lot of different ways that you can be paid. And we have looked at 5 of them today, the most common ways to get paid. And it's going to help you make an informed decision around which lender or bank is right for you. And it really helps you determine before just jumping to another lender or another company, because loan officers do switch every 2.5 years on average. So if you're a loan officer looking for a better way to get paid, you're going to want to check out one of my upcoming videos. I'll be talking about how to pick a lender to work for and what to compare in addition to pay structures, because it's just one piece. So make sure you subscribe to this channel so you don't miss any of our upcoming videos. And I would really love hearing from any of you in the comments if you have a question about how you're getting paid, how commissions are structured, or any of the information that we talk about in this video. Otherwise, I'll see you guys next time.